There's a lot of momentum behind gold. But there's a lot of things saying gold ought to have been falling, and it's not. So what will happen if the Federal Reserve reduces interest rates, which would be historically good for gold? What will happen if the inflation rate starts to creep back up again, as I think it will I think it will during 2025? What will happen if China resumes its buying? And they may well have already done so this month, we don't know. What will happen if the dollar starts to slip in value because they've lowered the interest rates and therefore it's less attractive and therefore the DXY starts to go down? So if all of these things which have been negative for gold and the gold was going up with the negatives, then they turn positive for gold, what will happen to the gold price? Well, I think it will rise faster than it has been. So I think we're my personal opinion is we're very early in the cycle.
Yeah, so the black swan concept, I mean, they seem to happen once every decade, right? And we're working on almost a half a decade now since the pandemic. So, something's probably going to be coming soon, something unforeseen. And with the debt situation and the debt servicing as it is, and all the geopolitical tension as it is, and all the, political tension inside the United States as it is, I can see what you're describing as happening as very high risk at this point. Let's focus on the geopolitical side for a moment here. Russian President Putin has recently shared conditions for peace, but then the West quickly dismissed it. The U.S. Congress has passed a new law making it easier to conscript American young men and women to military service. President Biden said it was okay for Ukraine to use U.S. manufactured weapons at targets inside of Russia. Putin told the world they aren't afraid to use their nuclear arsenal under certain conditions, and then also move nuclear subs and warships 90 miles off the coast of the U.S. Over the weekend, a drone strike in the middle of Russia is now being blamed directly on the U.S. by the Russian defense secretary. Clive, war drums are clearly ratcheting up, not down. In your estimation, where is all of this going? How concerned are you?
I've never been as worried as I am, or at least not since 1980. I think in 1980, we had the same level of tension. Russia had invaded Afghanistan, and America decided to go in and fight Russia in Afghanistan. And the world was literally on a tightrope then. And of course, before that, before my time, we had the Cuban crisis back in the 1950s. It's very dangerous to poke the bear. And that's what I see the West doing. I'm not sufficiently up to speed with geopolitics, but it does seem crazy to allow or supply weapons from America to Ukraine, which are capable of striking targets deep in Russia. Having a month or so ago sent in some drones, and we don't know if they were American drones or Ukrainian drones, which took out part of Russia's anti-nuclear early warning defense systems, probably only temporarily, I suppose. But, if I was Russia, I would be saying, how do I know that these long-range missiles aren't nuclear tipped? I can't know. And, Russia's made its warnings very clear. They've said, listen up, NATO countries. Some of you are quite small European countries with large populations. You can't be supporting this. You shouldn't be supporting this. And you will bear the consequences. That's what Putin is saying. And people have said, well, some people are saying, well, he's bluffing. And he's responded to that. He said, well, I might be bluffing. And I'm bluffing until I'm not bluffing. And how long are you going to keep calling the bluff? How long are you going to keep poking the bear before he strikes back? So I think it's for me, from my point of view, it's extremely worrying. I don't think people see that way. They've lived all their lives in peaceful conditions, and they imagine and hope, and I hope too, that it will carry on exactly the way it always has been. But I think if you keep your eye on the geopolitical things which are unraveling, the direction of travel is the wrong direction at the moment. And I'm hoping that the people in power can see sense and get around the table and do some talking and try and reach some sort of deal. Neither side is going to be happy. Russia's not going to be happy with the outcome, and Ukraine's not going to be happy with the outcome, and America's not going to be happy with the outcome. But there's got to be an outcome which doesn't involve escalating the situation.
Which is all everybody's doing. So, we've talked about de-dollarization. We've talked about a little bit about deglobalization. We've talked about AI and this infrastructure build out to support AI, the electrification of everything, the lack of investment that is leading to the supply shortfall in many things across the periodic table. Does your analysis, Clive, point to a historic rotation out of financialized stocks and into hard assets, commodities, precious metals, miners, et cetera, upcoming? And if so, what will ultimately be the catalyst in your view?
I think that it's a good time to be increasing exposure to commodity type companies, but at the end of the day, it's not just that. There's an awful lot of good companies, very, very good companies in the stock market, which are not overpriced, but there's a small clique of companies at the top of the pile, which seem to be in one case at least quite expensive, and other cases a little bit too expensive. And I think what's going on here is people were throwing money into these top companies directly and day trading them in and out. And of course, we had a lot of volume, and the price was going up as more and more people came in. But we've kind of reached a point where people are saying, I don't really want to buy these top companies anymore because I should have bought them 6 months ago or a year ago or 2 years ago. And if I buy them now, I might be the last guy, and then I look like a fool. So I don't really want to. So I'm going to look around and find something else to buy. And now they're looking around the opportunities, and they're finding some top performing funds or ETFs. Oh, that one's got a good performance. I think I'll put my money in that. And those top ETFs own the very stocks they didn't have the guts to buy in the first place.
Exactly.
So that's what I think is driving the market at the moment. I think it's not people going in and buying these individual stocks at twice the price they could have paid for them a year ago. It's rather people are putting their money into top performing funds, which have no choice but to buy these top performing stocks because they're a major part of the index. And that's what's continuing to power those prices ahead. Now, in a world of increasing money supply, and wealth because of the debt being increased, that could continue for quite some time. But of course, the longer it continues, the more and more rarefied air we get into. It could be a bit like Amazon in 1999 and 2000. Amazon was flying really, really high, reflecting a future that everybody dreamed it would have, and eventually it got that future, but when things started to go the wrong way, we spent more than a decade severely underwater.
I believe Amazon dropped about 90% during the dot-com bubble, and it took over a decade to even get back to par. Isn't that correct?
Well, the Nasdaq itself, if you measured over 3 or 4 years, did 3 years after the collapse, did that. So yeah, it was pretty much par for the course for everything in Nasdaq. Yeah. Obviously, it was like down 30-something year 1, 30-something year 2, 30-something year 3. And you didn't have a lot of money left if you had bought at the peak.
So sounds like to me that, you're not sure how long the current move is gonna take to play out, but that it's a good time to be ratcheting up, acquiring more and more commodity assets. But at some point down the road, you do see a move there. You just don't know when that's going to happen.
Yeah, I mean, I think we'll talk about two things. One, what I'd be doing now, and two, the moment when the rush for gold, specifically gold, comes. So what I'd be doing now is being more broad-based, but moving down the scale, avoiding the mega caps, which not totally avoiding them, but certainly underweighting the mega caps at this point, and going for the middle of the range, the mid caps, and even the small caps where there's very, very good value. And for that to do it right, you've probably got to choose an ETF or a fund rather than try and stock pick yourself. But down the line, yeah, sorry, go ahead.
No, go ahead. Go ahead.
So down the line, we get this, in all likelihood, concern about a currency, and people start to say, what can I buy with it? And of course, the first thing which might happen, they might start to empty the toilet rolls out of Tesco's, or Walmart, or whatever it is. I mean, I say that because that's very facetious, but it could go much further and faster than that. And then the problem is, what's going to do? What are they going to do? Are they going to bring in ration coupons to say you can't empty the shops? Are they going to try and find some way to limit what we spend? Are they going to try and bring in capital controls to stop you speculating against the bond market or the currency or anything? We don't know what things might happen, but I'm going to give you one of multiple possible scenarios, and that is a scenario which might happen after the central bank digital currency has come into existence. Now, a lot of people may have heard the word CBDC, or central bank digital currency. I did actually today meet somebody who'd never heard of it. So there are people out there who haven't heard of it. So if your listeners are saying, what's that? Don't be embarrassed that you don't know what it is. The central bank digital currency is the new currency which is designed to replace cash by the central banks. It'll be issued by the central banks, but it will be the same as the dollars in your pocket, or the pounds in your pockets, or the euro in your pocket, and you'll be able to change the money you have in your bank, the euros in your bank, and put them into the euros in your digital wallet. But they'll be, at that point, they'll become central bank digital currency euros, or central bank digital currency dollars, and so on. The point about this is we are effectively going to be dealing with two different currencies, which are like dollars and cents. They look the same, they sound the same. 100 cents is a dollar and a dollar is 100 cents, but they're not the same thing. And what that means is, when the crisis comes, if they have got the entire economy operating on the CBDC, and I see that as the direction of travel that they would like. So to start with, they've got the people paying with the CBDC, and that they're paying with cash, and they've got the money in their bank, and they're paying from their bank as well. But as time moves on, they're going to gradually gravitate things more and more towards the CBDC. So your salaries go to the CBDC, your day-to-day spending goes via the CBDC wallet, which could be your bank CBDC wallet or your CBDC wallet. And later on, your financial transactions have to be via the CBDC wallet, until, for money laundering reasons, for tax evasion reasons, we want everything to go through the CBDC, because we've got to make sure that there aren't any criminals out there using our money in a bad way. So because it's possible to monitor everything through the CBDC when it's not possible through your bank and it's not possible with cash, I think the government's got a great desire to see everything gravitate towards the CBDC in the end, even though they'll give us lots of reassurances that they'll never spy on us and it'll never happen and cash will always be there. I think that's the general direction of travel. But the trouble with that is we end up with two currencies: your old dollars, which you can put in your CBDC wallet and they become new dollars, or your new dollars, which are the CBDC dollars in your wallet. When the crisis comes, it'll be all too easy to bottleneck how much you can put in your CBDC wallet, or to limit it according to the purpose for which you're going to spend the money, or limit it according to the type of person you are, or whether you're a local citizen or a foreigner. There could be all kinds of rules brought in which would prevent you from deploying your old wealth in the old currency for the purposes of doing anti-government things like speculating against your bond market, or speculating against your currency, or buying everything in the shop as a rich person before the poor people get it. There could be all sorts of things. So I think, why would they, in such a crisis, bottleneck it? Well, it's the next step towards abandoning the old government debt, because the All the bonds on the planet are issued in the existing currency, the dollar or the pound or the euro. But once we got the CBDC up and running, we effectively have two currencies. And when you bottleneck it enough, you could effectively leave behind the old currency as an unusable currency, a defunct currency. So if we get to a situation where the window to transfer your old maturing dollar bonds into your CBDC wallet is temporarily closed, I'm going to use the word temporary because they'll always use the word temporary when this happens, you won't be able to spend those old dollars at the time. And therefore, it won't matter how many government bonds are outstanding in the old currency because there's nothing anyone can do to affect the economy. So they're starting in the new currency, the CBDC currency, with a debt to GDP ratio of exactly 0, which gives them plenty of money to bail out all the local citizens who've been hard done by due to the fact they can't spend their old dollars, like old age pensioners, pension funds, poor people, deserving people of every description. And they will still only have a debt to GDP ratio of 5% or 10%, nothing like the 100 and something percent they've got today. Meanwhile, all this old debt is left behind. They haven't defaulted on it because they're still servicing it, but they're servicing it now with monopoly money that nobody can spend.
That's incredible. Okay, so you mentioned a rush to gold. Let's talk about gold real quick here. Recently, the gold price has been hitting all-time highs in practically every currency. What is that price action telling you? What do you see for the gold price over the next few years, and what role do you see gold playing in the global financial system over the next several years?
So, first of all, what's been going on? We've seen in the last 2 years a fall in the CPI inflation rate from 6-point-something% to 3-point-something%. So inflation has halved and the gold price has risen substantially. We've seen a rise in interest rates from 0 to 5.4%, which is historically said to be bad for gold. Yet the gold price in the same period has gone up from $1,000 to over $2,000. In the month of May, there was no announcement by China, but they didn't actually buy any gold for the first month in 18 months. A lot of people said there was an announcement. I didn't think there was an announcement. They just didn't buy any because their gold holdings at the end of May were the same as the end of April. So they weren't in the market in the month of May. Yet towards the end of May, gold hit another all-time record. In fact, it hit multiple all-time records during the month of May, in a month when one of the major buyers in the world wasn't there. So, and recently, in the last year and a half, we've seen the dollar index, the GDX, which is represents the dollar's value versus other currencies. We've seen that rise in value. The dollar's gone up. Normally, rising dollar's bad for gold, but the gold price nevertheless has continued to rise with all of these things, which should be historically negatives for gold. So what that's telling me is the market doesn't care that the official inflation rate's going down. The market doesn't care that interest rates have gone up. The market doesn't care whether China buys gold or doesn't buy gold. There's enough buyers out there to keep driving the price higher. And whether if it wasn't China buying, it was probably India for all I know, but certainly the central banks are buying. So there's a lot of momentum behind gold. So, but there's a lot of things saying gold ought to have been falling, and it's not. So what will happen if the Federal Reserve reduces interest rates, which would be historically good for gold? What will happen if the inflation rate starts to creep back up again, as I think it will I think it will during 2025. What will happen if China resumes its buying? And they may well have already done so this month, we don't know. What will happen if the dollar starts to slip in value because they've lowered the interest rates and therefore it's less attractive and therefore the DXY starts to go down? So if all of these things which have been negative for gold and the gold was going up with the negatives, then they turn positive for gold, what will happen to the gold price? Well, I think it will rise faster than it has been. So I think we're very, my personal opinion is we're very early in the cycle. Of course, this isn't investment advice. It's what I personally think. And I can tell you that I'm a steady and slow buyer of gold. When I've got a bit of cash free, I'll pop down to the coin shop and buy a coin, or if I've got a bit more, I might buy an ETF or something. Probably my last purchase was a month ago, which would have been close to the peak. And so it's $100 below the peak now, so it's a better time to buy now than it was then. So I'm not afraid of the price at the present time. I think we're heading for much higher territory. Certainly, if there was any type of monetization of gold, which I think is a likely way forward at some point, it will be in a scenario where the old currencies cease to have any value at all, or where the old currencies are pegged to gold at a very significantly higher price than today. There's every number under the sun, depending on how you calculate it. But if you calculate it compared with the amount of government debt which is out there, you're ending up with figures in excess of $100,000, $150,000 for gold. If you just measure it to money supply, you're still at $8,000 against gold. You can take any number you like, but the fact is, if they were to try and back the currency to scale in some sort of panic, it would have to be at a considerably higher gold price. But probably it would be not the old currency wouldn't be backed by gold at all. It would have to be the replacement currency. And to give, if a currency's just failed, you have to give people confidence in the new currency. And the way you give people confidence is by allowing them to change it into something tangible. And what have we got on this planet? Offering to let them change it into land isn't much use, because people aren't going to, you can't walk along to your bank and say, here's $1 million, please give me my acre of land anymore. I mean, perhaps you could do that 150 years ago. Of course, there's Bitcoin, but the central banks don't have any Bitcoin yet. Not enough to make a difference. I mean, hope maybe one of these days the Swiss bank will break ranks and be the first to buy some Bitcoin, because they seem to be the most favorable towards it. But central banks don't hold it. So what have they got? It's gold. So I think at some point we go back to some sort of backing of a new currency against gold, and of course that does mean your gold is going to buy you an awful lot more than it buys today, because it's been for a long, long time an out of favor asset compared to the creation of wealth elsewhere on the planet. Yeah,
I'm in agreement, and that's why I started this Metals and Miners, to share that message that you just shared. So before we wrap up, just real quick here, two things. I'd like to get your thesis on both the gold miners and the silver miners, but also your silver thesis as well.
So anybody can go to the Silver Institute and look at the supply and demand statistics for the last 10 years, as well as for the last year and for the 2024 projection. What you will see is that for the last few years, the annual production of silver has been declining, and it's less than it was a decade ago. So the silver production is fairly static, but drifting downwards. So silver is from quite a lot of the silver which comes into this, gets to be used from mining, is a byproduct of some other mining operation. Of course, there's some silver mines which mine only silver, but quite a lot is coming from as byproduct. So it's not terribly affected by the price of the silver itself, but more by the value of other metals which are mined alongside it, and therefore silver happens to just be a spare bit of it. But the reality is here, in the last year, the silver reduction was the lowest in a decade, and next year it's going to be lower according to the official statistics. Now we come to the demand for silver, and that has been rising every year, year after year, and the largest increase in demand, which came between 2022 and 2023, was in the photovoltaic area. I guess that means solar panels, where the demand for silver in that area went up by something like 47%. I speak from memory here. I haven't got the figure right in front of me.
Military weaponry is probably also a big driver?
Well, yeah, they didn't write that one down, but it is said that there's quite a lot of silver goes into these weapons.
Yeah.
And they're forecasting that the photovoltaic industry will consume an extra 20% silver this year. And the biggest consumer of silver is the electronics industry. And I think the figure last year was an increase of 20% in electronics consumption of silver. So we got some very big rises in two of the key components of silver industrial usage, going up sharply, whilst the mining production is going down. And that's what's been squeezing the silver price higher, because it has to go higher to suck out the scrap silver, so that the grannies take along their candlesticks and knives and forks and spoons to the pawn shop and say, "What will you give me for these?" Because I saw on the news the price had gone up. So that sucks out the scrap silver as the price goes up, to sort of balance the books a bit. But the reality is we've got very, very fast growth in silver consumption. And I think one of the big drivers going forwards will continue to be the electronics industry, and in particular, data centers, which of course is, some people call it AI, artificial intelligence, but let's just call it data centers. They are, the world cannot build data centers fast enough. They're struggling to build them. And even more importantly, it's impossible to get electricity supply to these data centers. So, that's where the bottleneck for AI is coming, is electricity supply. But putting that to one side, let's assume they figure that one out. All of these processes they're getting smaller and smaller and more microscopic, and the best way of conducting electricity is pure silver. You don't need a lot of it, but collectively you're going to need a ton of it, and that, I think, is going to keep consuming more and more silver. I came across, funny enough, today I came across an essay I wrote when I was 14 years old, and one of the things I did predict we'd need more of in the future was batteries. I think I was not wrong, but I think if I was writing the essay today, I might well say silver's one of those things we're going to need a lot more of, because it's a key component of electronics.
So to read between the lines, am I to take away from that you, because you're so bullish on both gold and silver, both of the precious metals, that you're also bullish on the miners?
Yeah, let's talk about the gold mining stocks and the silver mining stocks. They have been left behind as the gold and silver price has been rising. A lot of people simply didn't believe that it was rallying. So we've had a decade where silver mining stock prices and gold mining stock prices are way below where they were. And I can't precisely give you a date without looking at the chart, but I'm going to call it a decade ago, when gold and silver have, let's say, gone up 100%, and these mining stocks are down 50%. Something like that. That's a sort of order of difference.
Yeah.
They're starting to recover, but there's a huge catch up to be made by the mining sector. And of course, if the gold price rises, if the silver price rises, that has a leveraged effect on the profits of a company. So if a company is extracting its gold at, let's say, $1,000 an ounce, and the price is $1,900, it's making $900 an ounce profit. But if the price of gold is now $2,400, it's now making $1,400 profit, which is an increase of 50% roughly in its profits, even though the gold price only went up from 1,900 to 2,400, which might be only a 15 or 20% rise. So there's a leveraged effect on the profits of gold mining companies, on silver mining companies, when the price moves. And with the price rise we've seen in the precious metal price itself, those profits from the mining companies are likely to rise very, very significantly when we get to the end of 2024. In other words, assuming the price stays where it is, we're going to see massive profits from these gold mining companies. And that, of course, brings down their price earnings ratio, which makes them look much cheaper, especially if by that time people are starting to change their view and say, I've got to have a bit more gold exposure in my portfolio. And the way to do it, will be the gold mining. One of the ways to do it will be the gold mining stock. So I think they're going to, in all probability, outperform the precious metal itself, and I think probably big time.
Yeah, that's really positive. And what you just described there is likely to bring in institutional investors if they're looking, in my opinion, and you could tell me if I'm wrong, but if they're looking at these overpriced ETFs and mutual funds and the clickish technology companies that you had referenced earlier, and there's not a lot more juice to squeeze from that lemon, so to speak, and now they are looking for profitable companies, and they're looking over here and they see, oh, look, these gold mining companies are starting to move. Their PE ratios are down. They show a lot of promise. Maybe they start deploying because they also see there's really no end in sight for the price of gold to continue rising.
Yes, I think so. But I think if we have a fall in the Mag 7, if you like, it will bring down the mainstream indices quite a lot. Let's call it 30% for simplicity. But it doesn't mean to say that all stocks are down 30%. It means a small clique of stocks are down more than 30% and the rest are down 10%. Now, what that does when the index falls is creates a lot of fear and worry and uncertainty. So I think at that point, people will, if that does happen, they'll be looking at the precious metals itself more than trying to buy a gold mining company or a silver mining company, because anything in the stock market will make them nervous. Of course, they will buy those things, but I think there'll be a rush into gold and silver, but gold in particular, because it will be perceived as a very safe bet.
So is that your expectation coming up in the next 6 to 12 months, is a market drop to that effect?
One of the things I learned in my 50 years of investment is you can give a prediction, but don't put a date on it.
Okay, so forget the 6 to 12 months, but that is something that you do foresee coming.
Yeah, the way of markets is they become overextended and then they go down, and sometimes they go down a lot. But let's go back to a period which I did live through, was 1994 to 2000. In 1994, stocks were very overvalued. The dollar was, interest rates were going up. I can't remember what's happening with the dollar, but there was some trouble with the dollar at the time in some way, shape, or form. Everything looked dire, and people were saying, don't invest in stocks, they're way too high. And then we watched for the next 6 years the greatest bull market in all of history, off the radar screens, where the market went up 2 or 3 times its previous level and continued upwards, and there was no stopping it. And certainly once we got to hear about the word .coms or internet, there was a period in the mid-90s when all a company had to do in its annual report was say, we now have an email address called sales at da-da-da, and the share price would double. And what's going on today? All a company's got to do is say, we're working on AI, and up it goes. The lesson we all learned in 1999 and let's call it from 97, even 96 onwards, was the minute you sell anything which has gone up, it would immediately double the day after you sell it, and then they'd split and it'd be back to square one with half the number of shares you started with.
So what you're describing, though, is a speculative rocket ship bubble, right? Do you foresee a speculative bubble forming in the precious metals when folks start turning to precious metals?
Yes, it will happen. But right now the bubble is in the AI, in the technology stocks, and I can't tell you how high it goes. It's dangerous to run. It's dangerous to run with the lemmings, but it's also dangerous to run in the opposite direction.
But no, I agree. But my question basically is, when that tide finally turns, and they do start coming over to the precious metals, you do foresee a speculative bubble happening even there too.
I'm pretty sure history will repeat itself. We've had speculative bubbles in the silver price in particular, and of course the gold price, going back in history. And I think when people are diving into it, it will become the word which is on every TV screen, every newspaper, every website. You'll be having people looking up the gold price by the second. And yes, it'll become a speculative bubble, and it will go way beyond what people are expecting at the moment.
Clive, this has been a wonderful conversation. There's so much more I wanted to talk about today, from energy to copper and palladium, and there's a whole bunch more. But our time is so limited. Before we wrap up here, and I ask you the final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview like this one that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Clive as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, it's time for our Golden Nugget segment. Clive, let's discuss portfolio positioning based on everything we've discussed today, and with your experience and your worldview as the backdrop. How are you positioning for the next 1 to 3 years? What assets do you love, and what assets do you absolutely want to stay away from?
Well, let's start off with what I would like to stay away from. I don't think there's enough value in bonds at the moment. It's not to say you have to have zero, but I don't think it should be a major part of any portfolio which doesn't have foreseen spending needs. So it would be very low or zero. And likewise with cash, you need to keep enough cash depending on your personal situation. If you've got a job, if you're retired, not got a job, if you've got some bonus coming, if you've got cash flow, depending on what you've got coming to you, you need to keep a certain amount of cash for your unforeseen needs, spending, surprises, or opportunities. You never know if your next door neighbor's house is going to come up at a bargain basement price and you'd like it. So keep something spare for your unforeseen needs. But if you have more than you need, you have to deploy it into tangible assets of some kind. And that does include the stock market. And I would also say it could include Bitcoin, although most people would say that's not tangible, but it's widely regarded as a limited supply asset, which people do want, and the number of people wanting it is growing. The second thing I'd say is when you're deploying your assets outside of banks, with bonds and cash, two things to think about. The first thing is custody. Everything you hold with a financial institution, you need to ask them permission to get your money. So when you go online and try to pay somebody, you're effectively asking your bank for permission to use your money. And you have confidence that they'll never say no. And I have confidence they'll never say no, but you never know. And I remember when Russia first invaded Ukraine, there was an awful lot of Russians who basically suddenly found their cards and their bank accounts were blocked. Well, the banks decided to, or tried to figure out who was sanctioned and who wasn't, because it wasn't like oh my God, he's got a Russian name, block his account. And we saw that on, I don't know if you saw this, but there were plenty of people in UK there was a lady, her surname was Tolstoy, that's right. So she suddenly found her account blocked because of her name. She'd at one point in the distant past been married to a Russian, but there was no reason to block her because of her name. But that's what happened. So you have to remember, if you have your assets held by a custodian, you might have to ask permission. Therefore, it makes sense to have assets where you don't need to ask permission. Of course, gold coins or bars, which you can access easily, would be one of those things. But there's plenty of other things. I'm going to give you a few ideas. One of the best places of deploying money, and I'm moving on to the other side now, is I'm going to call it buy now. Improve your property, do a loft extension. If you can't afford that, put a greenhouse in your garden. If you have too much money and you want to buy some tools down the road, maybe buy next year's toolkit, buy your power generator for next year. You're probably planning to exercise when you get a bit older. Well, buy your exercise machine now. Don't waste time. If you've got children or grandchildren, you're thinking of making gifts at some point. Well, why not make it now when they can spend the money that you cannot, or buy their birthday presents now? every little bit that you can do to reduce your exposure to cash to as little as possible, or as little as you actually need, is a good idea. So what I would say is, just don't overdo it in terms of cash and bonds. Make sure the bulk of your wealth is in property, equities, gold, silver, heirlooms, if you like, or collectibles, or anything else you can lay your hands on, which you think will hold its value because people desire it and it's valuable. So you could, for example, if your passion happens to be whiskey, well, why not collect bottles of whiskey from distilleries which have gone out of business? There'll never be any more of them, as an example.
Yeah, these are all some wonderful ideas. Clive, thank you so much for coming on to the Metals and Miners podcast, and for being so generous with your time and your analysis and all of your ideas. It's really been amazing to spend this time with you. Would you share with the viewers any final thoughts that you want to leave with those tuning in, where they could learn about your work and how they can connect with you?
Sure. The only place I write, and I do write 5 times a week, maybe, is on LinkedIn. I write articles on everything that I can think of under the sun. For example, yesterday I wrote an article about what the father of all scam artists or securities frauds, who wasn't Bernie Madoff. It was a man who, in the 1800s, imagined a country in his sleep, wrote a book about it, and then started selling land in this imaginary country. The bad news was hundreds, if not thousands, of people tried to emigrate to the country on ships, only to find that the country, which is part of Honduras and Nicaragua today, was not the green and fertile land which they'd been led to believe, with rivers flowing full of gold. And most of them died of malaria. But he was the father of all securities fraud. And so, but that was one example of things I write. But I write about the central banks, I write about the jobs numbers, I write about inflation, I write about gold. On LinkedIn, that's the way to connect with me. If you connect with me and you have a question about your wealth, I have nothing to sell. I don't have any legal advice to give. I don't charge any money for it. But if someone's got a question, like they've inherited some money and don't know what they should be doing, or if they've got a house, should I rent it or should I sell it? We can have a dialogue, and I hope that I can help them find a direction of travel.
Clive, you've been amazing. You are amazing. I've been following you for a while, reading your material. Folks, if you don't follow Clive on LinkedIn right now, you really do need to connect with him. A half a century of knowledge and experience that he's just so graciously sharing with everybody, really serving all of us. So, Clive, thank you so much for that. I look forward to having you back on sometime soon. Thank you for being here, and everybody else, thank you for watching.
Well, thank you very much for inviting me, Gary.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, the economy, markets, artificial intelligence, individual metals and miners, and every single expert interview like this one that we conduct. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.